Hello and welcome to Charting the Markets with myself, Richard Snow from Daily FX. We really have quite a lot to consider, not only today, but throughout the rest of this week. We obviously have the ongoing conflict in the Middle East. We're seeing some progress there as far as diplomatic efforts are concerned, and that adding a little bit to this sort of relief that we're seeing across risk assets. We'll get into that in just a second. But we also get mega cap tech earnings this week, that getting underway from today. We see earnings from Microsoft and Alphabet. That's after market close. So we could be seeing a little bit of jostling and positioning in the US indices towards the end of the US session. We've also got tier one economic data. We've got US GDP Q3 print. We've also got some inflation data out of the US. So really across the board, we've got quite a lot to consider. So I think first of all, let's dive into the charts. Let's take a look at the US dollar basket. So if we're taking a look at the DXY chart, what we've noticed over prior sessions is that there's been a sort of delinking between US bond yields and the dollar. Now, typically, they tend to move in the same direction. And while we've been seeing yields, US yields, particularly the 10-year benchmark, moving higher, we've failed to see that same sort of movement in the dollar. That is something that appears to have come back into play. We're seeing that link once again yesterday. We saw quite a drastic sell-off in US 10-year yields. And as such, we've seen a move lower in the dollar basket. So it appears as if that is something that needs to be considered going forward. And looking at the dollar, much like other FX pairs, we've seen a sort of consolidation, easing of rather mature trends, and we're struggling to see continuation really taking place at the moment. I think the bar for that remains quite high. So apart from the fact that we saw the dollar responding favorably to that marginal CPI beat, we're not really seeing more momentum behind long dollar plays. And of course, that is quite a crowded trade at the moment. So looking at the path of the recent price action, we've noted that peak at 107.34. And indeed, we've made a lower low and a lower high. Looking to obviously build on that if you are to reinforce some sort of bearish bias from here. But we've got some telling levels currently underway. We're seeing the test of the prior swing low. But at the moment, the dollar sort of holding above those levels. So 105.63, something to look out for on the downside. Not far from there, we get the 50 SMA, the simple moving average. That's the blue line that could provide some support for the dollar, potentially moving into those tier one data points I mentioned at the start of the broadcast, namely the first look at Q3 GDP for the US in an economy that's actually outperforming on a relative basis. So we're looking at a positive print of 4.1%, the US economy continuing to expand. And with that, it brings the potential for a December interest rate hike potentially from the Fed. So we'll look at that as far as it relates to long continuation within the dollar index. Moving to euro sterling, this is a particularly interesting pair today. Obviously, we've noted the bullish break to the upside, and what we noticed is there was a bit of a reluctance to trade higher around this prior zone of resistance, and that coming back into play once again. Initial indications that we could be, seeing a lack of bullish momentum. If we look at these two daily candles, the long upper wicks suggesting that we're seeing that rejection of higher prices round about that zone of resistance. So we also had some sterling and euro-based news out earlier today, or economic data, I should say. We had the UK and EU PMI data, both of those not really doing all that well. Those data points have been at low levels for quite some time now. But UK, we also saw unemployment data that was delayed a week by the ONS, but that coming out, seeing the unemployment rate in August at 4.2%, slightly down from the prior 4.3%. But more broadly speaking, we have been seeing unemployment moving higher, the unemployment rate moving higher, which is something that the central bank would want to see as far as they are concerned, obviously looking to get inflation back down to that 2% target. So with that recent data, the EU PMI data, doing worse than what we're seeing in the UK. So not surprising to see that move lower in euro sterling. And of course, as we mentioned before, we noted that reluctance to trade higher. So now immediately testing that 200 SMA, that's proving to be quite a challenge at the moment. So definitely want to watch intraday. If we are to see a close beneath the 200 SMA, well, that could signal a further selling into the rest of the week. So definitely quite a bit to look out for in this particular pair. If we now move our attention to dollar yen, this has been a currency pair of focus for a number of weeks now, in fact. We noted that 150 level on dollar yen, that has held firm for quite some time now, that being the trigger, essentially, well, according to markets, that could invite FX intervention from finance officials and the Bank of Japan. So we've been seeing very little movement on a daily basis above that 150 level. We saw that one spike above, beg your pardon, which created quite a sizable response. We don't have that clarity as to whether or not that was intervention from finance officials and the Bank of Japan. But nevertheless, markets continue to push that price higher. Of course, higher yields in the US are making things quite difficult, as the Japanese yields themselves have been moving higher, and the Bank of Japan looking to suppress those as much as they can to contain Japanese borrowing pressures. So for now, we're seeing a marginal drop in dollar yen. Of course, we saw the dollar declining somewhat yesterday, also on the back of US yields moving slightly lower. So that, again, being one to watch heading forward. So 150, that is the line in the sand. Very little price action happening around those levels, but always the potential for a massive move to the downside looms large. It's a matter of time, it would appear. And if we are to see a move back towards 150, well, that nervousness starts to creep in once again. So dollar yen, certainly another one to watch going forward. Now, if we take a look at US, global indices, should be said, the risk environment having somewhat of an effect there. We've noted a broad sell-off across the board, and at the moment we're seeing that sell-off starting to ease up somewhat. And I think a lot of that has to do with what we're seeing in the Middle East. Obviously, there's great potential for a broader conflict, and recent diplomatic efforts have actually made progress, whether it be through providing aid to where it's needed or to recovering hostages that have been taken. It appears as if the diplomatic efforts are yielding positive results, and that being reflected across risk assets. So if we take a quick look, we'll start with the FTSE first up. Quite an aggressive sell-off that we have been seeing. And as I mentioned, we're seeing that starting to ease ahead of this 73.05 level. The FTSE struggling to maintain any ground above the 200 SMA. We saw that break above, but that essentially being eroded the very next day. And since then, that selling has continued. But once again, we look at these wicks. They tend to be quite telling in terms of price action, and where we see extended wicks on the downside, that's often representative of a rejection of lower prices from here. So we could be seeing the bulls starting to make a return. And of course, if you look at the broader positioning, we see this market within a very large range. and moving close towards the bottom side of this prior existing range could suggest that we could consolidate, but potentially even move higher. I think a lot depends on what happens in the Middle East. So, but first indications are to suggest that if we see a slowdown in selling, we'd look at some sort of consolidatory phase from there. Levels of interest, of course, 73.05, just above that 73 flat level, and 74.20 if we are to see some sort of pullback materializing in the FTSE. If we look at the DAX, of course, the PMI data in the Eurozone really not doing any favors, and particularly in Germany, those figures, I believe the composite was still down this time around. And of course, we're seeing continued selling with the DAX. Of course, what was quite telling previously was this pullback into the prior zone of resistance, where we were met with the moving average crossover and a rejection lower. So the DAX selling off quite drastically, moving beneath that prior swing low and creating a new low yesterday. So another one to watch, but again, that common theme of the sell-offs starting to lose momentum. This is another decision point where we can assess, where we go from here, whether or not it's a period of consolidation or we see some sort of pullback on some good news out of the Middle East. If we take a look at the US indices, we've of course got quite a lot to affect US indices this week. We've got your mega cap earnings that will take place Tuesday through Thursday, I believe. And we've also obviously got the broader conflict and how that feeds into your risk appetite going forward. So again, seeing that sell-off in the S&P 500, not managing to get above the 50 SMA. And yesterday, quite tellingly, we saw that close beneath the 200 SMA. So that typically is indicative of a turnaround in the trend and potential further bearish selling. Prior level, we have traded beneath that. And yesterday we saw a relatively flat candle. So I think quite a bit of indecision coming into the market. We tend to see these sort of doji candles appearing around periods of indecision, which is not unusual given the fact that it appears as if the broader conflict is changing. Essentially, we're seeing progress on the diplomatic front there. So I believe markets just biding their time, perhaps waiting to see what happens, waiting to see how those earnings come across before taking on any additional risk. So definitely something to watch going forward. Now, the commodities market, we're seeing a little bit of the same in that this sort of easing in the risk environment is filtering into some of those dollar-based commodities. Of course, the dollar decline helps bring those prices lower as well. So the first chart we'll take a look at is gold. Gold, of course, a lot of the panic buying that we've been seeing, of course, not last Friday, the Friday before, that's where we saw this massive green candle to the upside. That was as markets were positioning ahead of a potential ground invasion in Gaza, which obviously comes with different consequences and different effects for financial markets. That would certainly be a very different landscape to be trading in. But nevertheless, with that appear to be delayed, we saw some consolidation before once again a pickup in aggression within the war, continued bombings that saw gold pick up another bid. But now we appear to have put in 2 sessions. Well, we're still busy with today's move, but we are seeing gold edging slightly lower. And of course, given the degree of the advance, it's not surprising to see markets cooling off somewhat. If we take a look at the RSI, we had just ventured into overbought territory very briefly and now heading back lower. So we could still see more easing, but again, this is it remains quite reactive and very sensitive to incoming news flows. So gold I would say the bias is still to the upside. The conflict unfortunately has a long way to go, it would appear, and gold you'd be eyeing the moves to the upside from here, but seeing a bit of cooling on price action for now. 1985 remaining the near-term level of resistance. 1937 the level of support, which coincides roughly with that 200 SMA. Those levels actually had been marked via this prior period on consolidation and coming into play once again. Looking at silver, we tend to see similar dynamics playing out within the gold markets that we see in silver. Although we've been seeing this move to the upside, it's happened at it's been less frenetic, essentially. Only just getting to the 200 SMA in silver before failing really to build on that close, which was ever so slightly above the 200 SMA. So seeing the price of silver rejecting that 200 SMA, heading lower once again. Today, we'll have to wait to see what this candle tells us. But intraday, we're seeing a rejection of that 2320 level once again, shaping up for a further pullback. Now, looking at oil. Oil, of course, is something the markets have been watching quite closely due to the location of the conflict and the potential for that to spill over into the oil market and have any sort of effects in a market that is so closely linked to fundamentals of demand and supply. Again, we're seeing the oil market selling off, broadly in line with what we're seeing throughout the commodity space. And we're looking at $89 a barrel on Brent crude, that now coming and testing the 50 SMA. So that is the next decision point for oil markets. Of course, a pullback lower it could materialize, but oil markets still remain fairly tight as far as supply is concerned. We've got OPEC maintaining their existing oil cuts. Also got Saudi Arabia and Russia maintaining their additional discretionary oil cuts towards into the end of the year. So the oil market, again, one that remains fairly reactive to incoming news flow. That about wraps it up for today. Certainly a lot to consider, a lot on the economic calendar, and also with the global risk environment. So with that, I wish you all the very best trading. Bye-bye for now.